You're watching Personal Finance with Coach Kelvin. Let's get into the video. Hey guys, Coach Kelvin here. Now today I want to talk to you about how you can dividend invest in order to accelerate your wealth creation, okay? So when you invest in shares in a company, an exchange traded fund, listed investment company, etc., there are a few ways that we can have value returned to us as the shareholder. So when you actually hold a company and they are earning cash flow and generating money, what they can do is invest into their business ventures. They could create a new product line, they could expand into a new market overseas, they could potentially look at buying, taking over a business after buying it and growing it that way through acquisitions. So what happens is the amount of shares that company holds is constant, the value of the company increases, therefore the value of those shares increases with that. If the company grows by 10%, in theory, so should your shares, but there's obviously other factors involved like debt, etc. Now, in order to return value to yourself when you hold a capital growth asset, you need to sell it. So that involves paying capital gains tax, etc. And that can be discounted if you hold it for longer than 12 months, but I can address that in another video. So when you sell, you obviously pay brokerage to get rid of those shares. You return cash into your bank account and you can then invest it elsewhere. You're also having to then pay your tax out of that. The second option that we can have value returned to us as a shareholder is through dividends. Now, when you have a company pay dividends, they're basically saying we feel we can't get the best return by investing this cash back into the business, so we're going to pay our shareholders. And a good way to think about this is imagine you're an employee to that company and they're just simply paying you a wage. You are a shareholder of that company and therefore you receive that dividend back to you because you're a part owner of this business. Now, when you have dividends offered to you by these companies, you can elect to participate in a dividend reinvestment plan if the company that you are invested in offers this. And DRP for short, or dividend reinvestment plans, are a brilliant way to start returning that growth back into your stock portfolio, because basically what happens is you would, instead of having that money put into your bank account for you to then purchase other shares, you would be receiving new shares of that company. So if you, for example, believed long-term in the company you were holding, so for example, I can use VAS as mine, so the Vanguard Australian 300 Index. If I were to hold this long-term, I believe that the whole ASX 300 is going to grow over the long-term. Therefore, I want my holding of this to grow. So if my Vanguard Australian ASX 300 fund can return dividends to me and I can have them reinvested, then every time I receive dividends, so 4 times a year, every quarter, I'm going to have those dividends purchase me more shares. Now, the beauty of this strategy is you don't have to pay brokerage to receive those shares. They basically grow passively in the background. Instead of receiving that money, Vanguard will issue me those shares, or whichever company you're invested in will issue you those shares. And quite often as well, they'll do this at a discount. So for example, there are particular companies and REITs that will offer a 1 to 2% discount just because you have elected to do DRP. When they issue those new shares to you and give them to you as the shareholder, you're already going to be increasing the value of your portfolio with a return of 1 to 2% just because you were offered those shares at a discounted rate. If, for example, you had those shares bought for you for $5, but their value was $5.50, you've actually earned 10%. This is just a very basic example, but I'm just trying to use that as an example to show you guys how that works. Now, with the DRP, what's great about this is it's completely passive. So if I no longer wish to add my funds into this ETF, into the VAS ETF, if I was actually looking to take a step back from adding my own capital to this, it would still grow passively in the background at a rate of about 4% per annum, okay? Now, when you receive dividends, this is classified as income. So you do pay income tax on this. However, when it comes to electing to do a DRP, you will do that at the end of the financial year once you go through all of your claimable items, all your incomes, etc. And it's best to speak to an accountant about how this works, okay? Because I'm actually not qualified to give tax advice. But if you are doing DRP and you're receiving those more shares, your portfolio will slowly grow, which actually increases the rate that your cash flow is returned back to you. So if I, for example, had 1,000 shares of VAS and I'm expecting a growth rate or a dividend return of about 4% per annum, what's going to happen is, okay, in the first year, I'm going to receive another 40 shares. So I now have 1,040 shares. In the second year, I'll then be receiving that back, okay? The dividend back on 1,040 shares. So 4% of that 40, I'm likely to get about 41 to 42 shares in the next year. So then I'll be looking at, in year 2, earning my dividends on 1,082 shares instead of that 1,040, even though I started with 1,000 at the start. And slowly the growth rate of this portfolio will sort of increase because your money is earning you money, which earns you money, which earns you money. And this is brilliant because you're not actually having to make extra contributions, but the growth rate essentially increases. And this is called compounding interest. Basically, compounding interest is one of the 7th wonders of the world, according to Albert Einstein. And when you earn compound interest, basically, when you have time on your side and you can invest for a long-term horizon, that basically accelerates exponentially the rate in which your wealth can grow. So for example, right now I'm 28. If I had a 40-year time horizon and I was looking to invest all the way up until I was 65, 68, let's say, 68, so I've got 40 years up my sleeve, and I'm expecting a growth rate of 4% per annum, at the end of this investment window, the rate that my wealth is going to grow is actually going to be faster return to me from dividends than it will from the amount I'm contributing. Now, I mentioned in my last video that I was looking to invest a minimum of $1,000 per month. As my wealth sort of accelerates and builds, eventually I'm likely to have more than $1,000 a month come back to me just because of the growth of my portfolio, okay? And if I was to still add that money, my contributions are going to grow or are going to be less than what my portfolio grows by every time. And this is amazing because basically what happens is the machine takes over and your portfolio will just keep growing passively. I mentioned that if I were to go into a coma for say 2 years and wake up, I would have more shares when I were to wake up and come out of that. And that's amazing because I would be earning money while I sleep. So the dividend reinvestment plan is a brilliant way to save not only on brokerage fees, but also to let your portfolio passively grow. And I believe in passive index investing or passive investing because this allows you to try and take out the psychoanalysis out of shares. You're not going to be subject to analysis paralysis where you try and overanalyze everything and you get sort of like stuck trying to make a decision and actually go ahead and purchase those shares, because what happens is the longer you hold it and the more you can control your emotions, you just understand that, hey, my shares are going to keep growing. Why I like my dollar cost averaging strategy of adding $1,000 per month as well is because it doesn't matter what the market's doing. It literally does not matter if the market's expensive today and I buy less shares and then it drops next month and I buy more shares with that same dollar value. It doesn't matter to me because over a long-term trajectory, my average spend is going to be less than the price of those shares then. So as long as I continually and consistently add my $1,000 per month at the same time, and if I can add more I will, but minimum $1,000 per month, this is going to allow me to keep growing my net worth. Now, the dividend reinvestment plan, when allocated to a portfolio, really sort of turbocharges that growth rate, because instead of me receiving cash and then having to decide how I wish to invest that, if I were receiving my cash dividends and then unsure of where to invest it and my emotions took over, I might say, you know what, today the market's actually a bit expensive, so I'm not going to buy. Whereas that may cause me to miss out on one of the best days in the market for that year or something like that. And therefore I am essentially crippling my potential returns. The more time you have in the market, the better off you are. There's an old saying, and it's try not to time the market, but spend time in the market. And that's my strategy for this. So by electing to participate in the dividend reinvestment plan, yes, while I'm still working and earning money, that will contribute to my income tax. However, what's fantastic about this is when I slowly start increasing my dividend income, I can slowly start taking a step back away from working full time and potentially start putting time into projects that matter to me more, because that money is going to subsidize some of the work I had to do. So if I were to make, say, $4,000 per year in dividend income, that may essentially be able to fund me to have 4 weeks off without changing my lifestyle, as if I was on holidays, okay? And I'm not saying this is what I would do, but it gives the potential for that. Obviously, I would be much better off reinvesting those dividends than spending them to live on, but you get the idea. When it comes to the day where I decide I want to retire, what I would then do is turn off my dividend reinvestment plan so that next time those dividends come in, they would land in my bank account, and then I could do with that money as I wish. That could cover my rent, or that could cover my living expenses or my next holiday, etc. So I hope this gives you guys a very good description of how dividend investing can turbocharge your investment horizon. It can basically cause that compound effect to occur much quicker than if you were relying just on capital appreciation. And if you look at long-term historical data from the S&P 500, dividend reinvesting in the growth of the whole market index, so in the top 500 companies from the United States, actually blows every other investment vehicle out of the water. It blows just capital growth stocks, it blows United States property, and in Australia we can also attribute a lot of our success and growth to how high the yield in Australian dividends are, and this comes from various sectors. So I hope that you guys can take something away from this video, and if you find value in it, please like and subscribe and leave a comment. And yeah, thanks for tuning in, and I'll see you in the next video. See you guys.